Had three alternative investment funds. Why and why now? The Indian listed equity markets for last few years have been very dynamic and reflective of the country's economic vibrancy. The markets have been influenced by factors such as government policies, corporate earnings, global economic conditions, and domestic reforms. Investors are now drawn to the potential for long-term growth presented by India's demographic dividend, ongoing structural reforms, and burgeoning middle class. The CAT3 alternative investment funds are continuing to attract investors for their unique investment strategies and potential for higher returns. The flexibility and agility of hedge fund managers in adjusting their portfolios to capitalize on market inefficiency or emerging trends contribute to their appeal. However, it's important to note that the unique strategies and risk profiles of CAT3 AIFs also require a thorough understanding of their operations, making them suitable for more sophisticated and accredited investors. Let's get on stage our next set of esteemed panelists to share more insights with us on this topic. I'd like to call upon Mr. Rishi Kohli, Managing Partner and CIO, Hedge Fund Strategies, InCred Alternative Investments Private Limited. Can we have a round of applause for Mr. Rishi Kohli? Mr. Vaibhav Sanghavi, CEO, ASK Hedge Solutions, ASK Asset and Wealth Management Group. I request all the ladies and gentlemen to please kindly settle down. Next, we have Mr. Siddhartha Bhaiya, Managing Director and CIO, Aequitas Investment Consultancy. Mr. Alekh Yadav, Head Investment Products, Sanctum Wealth.
Good morning, everyone. Welcome, ladies and gentlemen, for this panel discussion on CAT3 AIFs, why and why now. It's an honor to be, chairing this session, and I welcome my esteemed panelists today on the session today. What I'll do is basically maybe start a little with a few facts. Ajay has already covered a few facts when he did his introductory speech, but I'll speak about a few facts, and then we'll start with some question and answers. So category 3 AIF industry has grown by almost 2.5x in the last 5 years and has now crossed more than 1 lakh crore in capital commitment. That's a CAGR growth of about 20% in these 5 years. And when it comes to invested capital, then that number is 80,000 crores, a 3x growth in 5 years at a CAGR of 25% over these 5 years. The numbers, seem very good when we look at the fact that the AIF regulations came in only in 2012. So it's been like 10 years or a bit more of these, CAT3 AIFs. Just to remind people of what CAT3 AIFs are, they invest in, they could be long-only equity, they could be long-only debt, long-short funds, and they can take leverage. They can be open-ended as well as closed-ended. These are some of the differences compared to some of the other CAT2 AIFs that are out there. What we'll do is, perhaps start with understanding a few, CAT3 AIFs that, the panelists here run, and understand the various nuances of each of them and what makes sense from an investor point of view. And then we'll talk a little bit about why we should do CAT3 AIF, why should look at CAT3 AIFs right now. So maybe I'll start with Siddhartha, you first. Welcome to the panel today.
Hi, everyone.
So, the first question that I have is that you manage a long-only CAT3 equity AIF. You also manage money under the PMS framework. And this is an asset class which is a liquid asset class. You have ETFs, you have direct bonds, direct stocks, mutual funds, PMS, multiple routes for investors to look at. why should one look at a Cat 3 AIF in this particular segment?
So I think, it's just that like you have a Kirana shop and an Amazon and a food hall, right? So this is where you have a complete bouquet of offerings now as far as the Indian stock markets are concerned. You can invest in mutual funds if you're a retail investor. You have PMS, which is meant for the high net worth individuals, and then you have an AIF as well. So I run a PMS and an AIF both, and personally I feel that as a fund manager, managing an AIF is a far more easier task than managing a PMS. So it's just an alternative mode of investment for people to participate, or a vehicle for people to participate into the stock markets. And yeah, it's as you said, it's a very nascent industry, just 10 years. And hopefully going forward, we will only grow with time.
Sure. One follow-up question that I have is, while you run an open-ended AIF, there are some of these closed-ended equity AIFs as well. For some of the investors, those closed-ended AIFs may actually make sense. It prevents them from taking harsh decisions of exiting at the wrong time, etc. What's your take on some of that? And
again, as I said, it's you go to a supermarket and you have various products. Somebody might like Britannia, and somebody else might like Unibic, and somebody might like Parle-G, depending upon your taste so depending upon your financial requirements, you decide whether you want to participate in a closed-ended fund or an open-ended fund. Both have their advantages and disadvantages. Sure. And it's up to an individual investor. And typically, in the case of an AIF, you have a well-informed investor.
Yeah.
So to each his own.
Sure, perfect. Vaibhav, the next question is to you. You run a different strategy. You run the long-short strategy. You were running a long-short strategy, and now you're launching one at ASK. Can you help us understand, what are the strategies that you're looking to sort of run at ASK? And what are the nuances that an investor should keep in mind, and how does it fit into a client's portfolio?
Sure. Thanks, Alekh. So when we talk about long-short funds in India, long-short strategies actually is just an instrument to manufacture strategies across risk-return spectrum. Long-short can be used to kind of manufacture a very conservative strategy. At the same time, it can be used to kind of go and manufacture an aggressive strategy depending upon the client's needs in terms of their portfolios. So it's just a methodology to kind of achieve your risk, your objective in terms of your financial goals, looking into adjusting your risk in mind. Now, when we talk about our strategies, of course, this is something, our flagship strategy we will be launching very shortly. This is something which we have done for 10 years, and I do remember, when SEBI came out with these guidelines in 2012, they were very forward-looking guidelines in terms of AIF guidelines. At that point in time, when we launched our first strategy round in about 2013, it was a challenging task for us to kind of make people understand about what is long-short, why should you kind of enter into a long-short space, how does it kind of help in terms of achieving uncorrelated return. So that kind of educational process kind of went on for long, and by 2016 we were at about 1,200 crores. Of course, in my next stint in Avendus, probably we reached to a combined AUM of about $1 billion. But here, what I'm just trying to say is basically, with the 10 years of experience of managing an absolute return strategy, I think this is something which will launch the first one, and then move along different platforms and different risk spectrum in terms of the strategies which we will probably launch going forward.
Perfect. Thanks so much, Vaibhav. Rishi, moving to you. You also run a long-short strategy. It's slightly different from what Vaibhav would probably launch at ASK. What is the nuance that one should keep in mind, and what are some of the risk elements that one should keep in mind while investing in the strategy that you run?
Sure. Hi, everyone. Thanks for that question. So what we are doing in the current AIF long-short fund that we have is focused on absolute return and basically a low-risk, fixed income plus return kind of strategy. Where it differs from some of the other funds in the space is that there is no fundamental long short, firstly. And then secondly, it is very well diversified across many different types of short to medium term trading strategies, you could say. So we have largely 3 buckets. One is futures market neutral, where there's a lot of single stock futures based market neutral portfolios that we have. So, you rank the top 100 stocks in BSE using different factors. You go along the top 10 stocks, short the bottom 10 stocks, those kind of models. And obviously, you can have it across many, many factors. And then we have a second bucket, which is relative value, where we'll do a lot of volatility arbitrage, dispersion trading, and other things. And then we have an index futures and options bucket, where a lot of low risk futures and options strategies focused on the index will run. So mostly, people have 1 or 2 of the buckets, a few strategies, because most of the people in the industry are discretionary. Obviously, nothing wrong with that. That's just the style someone has evolved with. I and my team are quant and systematic guys. I've been among the first, quant people in India from 2007-8 on the buy side. Run a lot of FPI funds and global funds in the past. So a lot of that knowledge is being brought in here to create something unique in terms of the offering to the clients. And as Vaibhav said rightly, the good thing about long short is that you can spread across the risk return spectrum. So this is obviously on the lower risk side. We are planning to come up with something which is more equity plus kind of thing in a few months.
So, Alekh, if I just may add to what Rishi mentioned, when we talk about nuances in terms of what one should be looking at before deciding onto a long short strategy, of course, one important fact is basically the drawdown profile of that kind of strategy, which means, in a scenario-based analysis, what is the potential should the market go in either direction, what is the amount of loss one can probably have in a particular month. Whether that kind of suits to your risk profile on an overall portfolio is something one should definitely look for. Of course, statistics like standard deviation, which is volatility, and Sharpe ratios are something, which in addition probably one may evaluate while, taking the strategy on board.
Just a follow-up question on that. You speak about risk-adjusted return, standard deviation, max drawdown. For most investors, especially, who have like a 3-4 year time horizon, these are just facts. These are just numbers, and, it's not so relevant for them. How should they think about this? What is the impact that it will have on somebody's portfolio?
Sure. So let me give you one simple example. Now, when you are looking to invest in a fixed income kind of strategy, right? Usually, typically, you are kind of investing your safest bucket of your portfolio into a fixed income, where you may not want to compromise on the drawdowns or probably the loss, a potential loss, which may come about. So when you are deciding on a fixed income strategy, I think huge focus has to be given to how we are avoiding the tail risk aspect of investing. At the same time, to see to that my drawdown profile, drawdown meaning the amount of loss which I probably would make into 1 month. I mean, there are various definitions, there are peak to trough drawdowns and so on and so forth, but in simplistic language, say for example, in our case, in last 10 years, the maximum loss which we made in one single month has been 0.95%. Right? Yeah. So that is how it kind of achieves that color of a fixed income kind of plus strategy, right? So those are very important aspects. One, as a wealth manager, to advise a client of how this strategy is a risk-adjusted strategy. At the same time, looking at the financial goals of what the investor would want to, whether you want to have a fixed income or an equity bucket.
I'll just add to that.
Sure.
So, Vaibhav has brought out an interesting point. So the way to look at it is that, typical equity fixed income allocations we all used to doing, for a very, very long time. And we're talking of the low risk long short strategies replacing fixed income, maybe some of the equity plus strategy, like I mentioned, replacing equity. So how do you simply compare? I mean, how do you know that this is going to be relevant as a comparison in the fixed income bucket and, fund B will be relevant in the equity bucket? So that is where the drawdowns and volatility comes into the picture, right? So you benchmarked it with those kind of benchmarks. And as long as your volatility is similar or lower, you are a relevant comparison to that sort of asset class. If it is not, then I may tell you I'm a fixed income, but obviously that is not the right comparison. So that's one simple way to think about it. And then, of course, the only value you're getting is for the same level of risk, am I giving you higher return? Or for the same level of return, am I giving you much lower risk? So for example, there can be equity plus, equity minus strategies where for the same level of return, you may have much lower risk. Or for similar risk, you may have much higher return. So then it becomes interesting from an asset allocation perspective, both standalone as well as, if a wealth manager or a financial planner is asset allocating, then it will fit in somewhere. Also, very importantly, the correlations have to be taken into account, right? So what is interesting is that, even in the low risk side, if there are strategies I and Vaibhav and some of our other friends and competitors run, even we may be non-correlated with each other. So even then, both the funds may find a fit in your portfolio. So those are some of the nuances to look at.
Yeah, absolutely. As a wealth manager myself, so we keep interacting with a lot of HNI and family offices. And what we have seen is that, an investor who first says that, I'm a 5-year time horizon investor, I can digest volatility. At the first sign of volatility, he wants to withdraw money. Exactly. So, absolutely agreed with you on drawdowns and risk-adjusted return. On that point, Siddhartha, you of course run a more aggressive.
Yeah, I know. I'll have to spend some time with Vaibhav and Rishi to understand a lot of what they've said.
Yeah. So of course, you invest in the small cap space, the most volatile space. Yes. How do you look at, say, reducing risk for your portfolio? Of course, you can't mitigate all the risk that is there with small cap, but how do you reduce some of that for your set of clients?
I think, most of the people who come to stock markets want stock market returns and debt market volatility. Unfortunately, that's not possible. So the way I look at risk is very simple. Risk is permanent erosion of capital. If I buy some, and we've had instances when we launched our AIF, we launched it in March 19, the portfolio went down 50%.
Yep.
Right? Is that a risk to me? It's not a risk to me because COVID came and the market itself was down 40%. Since then, our portfolio has gone up 9x.
Yeah.
Right? And our CAGR for the last 4.5 years is 35%. Now, I know very well that in March 2020, nobody was a small cap investor. Everybody had moved to large caps and mid caps. And today, everybody wants to invest in small and mid caps, and we are away. So, the way I look at risk, again, as I said, is permanent erosion of capital. Right? I don't understand a lot of complicated things. And right now, the space is overheated, so we've stopped inflows. We are being cautious. We've created cash on the portfolio. And long run, you're going to make money in the markets, but it's the short term that you have to take care of.
Yeah. And you bring the point of, stopping flows and, of course, you stopped, we saw the post where you stopped taking inflows. In fact, small cap mutual funds, just to give some facts, have received about 40,000 crores of inflows in 2023. That's about 30% of their starting AUM of 2023. And in terms of AUM, they've grown by 80%. Of course, mark to market has also helped. How are you looking at, what are you suggesting, somebody who's a small cap investor already, what should he do? And for somebody who wants to allocate, what should he do then?
I think if you've not, typically again, as I said, March 2020, nobody wanted to invest in small and mid caps. It was just a very narrow market with the so-called Ritik stocks doing well. And today you're at the other spectrum where the SME IP index is up 100% in the last 1 year and it's on its own trip.
Yep.
So we're seeing completely this, and this is how historically markets have behaved through greed and fear and mania and panics. And what you see right now is mania. I don't know how long this mania will last. But at the end of the day, at some point in time, this has to stop. And when it stops, as Buffett said, that we are going to, is going to come out who's swimming naked at that point in time. So very cautious at this point in time. And I'm a small cap fund manager. I've done that for the last 20 years. And I'm very cautious at this point in time. Let me put it this way.
Understood. Just moving gears a little bit, and we'll talk a little bit about the industry. We started with the fact that the industry is small in terms of size and just 10 years old. If you look at the global hedge fund industry, it's about $5 trillion, yes. Or about 20% of the mutual fund AUM back in US. In India, it's less than, say, not even 0.5%. What, Vaibhav, do you think is the reason for that, and what would it take for the hedge fund industry to grow, especially the hedge funds, because those are, as somebody was quoting, about 15,000, 20,000 crores in AUM and maybe like 10, 15 hedge funds right now. what would it take for the industry to grow, and what would you like to see?
As you rightly mentioned, Alekh, I think globally, as a percentage of your total assets, we are about 4.5% in terms of the hedge funds. Now, if you consider $100 trillion, $110 trillion of total assets, you are about $4.5 trillion.
Yeah.
And within that $4.5 trillion is you have host of strategies, right from fundamental long short to quants to relative value, and so on and so forth. In India, I think we launched this, as I said, forward-looking guidelines in 2012. First of all, for us as a fund, it was immense amount of effort to educate people in terms of the, why you should have actually these strategies into your portfolio. Now we have reached to a place where the larger family offices, the larger corporate clients, or your HNIs or ultra HNIs or larger wealth managers as well, has a very decent understanding about the whole long-short strategy. So my sense is that the investment of 10 years in terms of public education, I think we are at the point where we could see some good inflection coming about. Secondly, I think one of the topics was, or probably one of the disadvantage was the lack of clarity in terms of the income tax, in terms of the first phase of this expansion of this long-short kind of industry. Now, of course, it is pretty clear, and there is still some amount of disadvantage in terms of as we compare to the other vehicles. But my sense is basically looking at where the government is going, bridging all the gaps, and trying to have all the strategies under probably one tax bucket. My sense is, I think again we are at the cusp where we are virtually, I would not say not preferred, but we are at the same parity in terms of those kind of tax regime. So we should see ideally a lot of progress happening, on the AUMs from this industry perspective, right? And lastly, I think I would say, availability of adequate talent in this industry, right? I think because the talent has been quite scarce, my sense is now that we are seeing a lot of prop shops, and now probably we are seeing newer talent coming into this, we will see a lot of strategies to be launched, more reach, and it is good on overall industry, where the whole overall pie has to be probably increased from here onwards. So there is a tremendous amount of growth. I mean, 4.5%, if you look at just mutual fund assets, we should be like about 2 lakh crores in terms of the assets, right? So I think there's a long way to go.
Sure. Rishi, just adding a little bit further to this, from a regulatory point of view, do you think there's something that needs to be done? Is the regulatory framework itself quite stringent when it comes to Category 3 AIFs? And some loosening of that could help growth of hedge funds.
So one thing is, of course, as Vaibhav said, right, the taxation thing, it's improved a little bit. There's a long way to go in terms of parity with other structures and some pass-throughs and other things that the industry keeps representing. So some development on that front would be obviously very helpful, and that is how it is globally as well. So there's no reason why we should be treated differently. But that's more a government thing. When it comes to the regulatory aspect, yes, I think while in 2012 the initial regulation coming in with 2x gross exposures was good, because you have to be conservative initially and see how the industry develops and what kind of strategies come in, etc. I think at least we are evolved that much that there are more strategies coming in, more players coming in. Vaibhav is right. 10 years back there were not too many talent, too many managers, too many strategies. Now you're seeing all of that happening. So I think it is time to sort of take a relook at some of those numbers. A very simple, I'll just give you a simple example, which we have told regulators in the past, is that you can at least split the gross and the net exposure, right? Having the same limit for both makes no sense. Net exposure 2x is a very, very healthy limit. But gross exposures on something which is almost market neutral, even a 3 or a 4 is very conservative and could work. So segregating that, I think, would be a good start. And we have to understand that the regulator has otherwise been very good over the years, and therefore they will have to take baby steps. And therefore this will be a good thing in that direction. That is one. Second interesting thing is that I agree that a lot of education has happened, and investors are much more aware of these strategies, but I still find that the moment you say low risk, long short, there's a particular type of strategy that the investors have in mind. And there it becomes very difficult for them to segregate between various different types of strategies. So I think some education is still pending. Industry needs to do more work. Investors need to understand as well how to segregate all of that, which will be very useful. And in that context, when it comes to certain types of option strategies, for example, again, I think the regulator can take a look at the way they've defined exposures and other things. Because sometimes, the intent with which those regulations were done is from 15, 20 years back, right? On all circulars, it is referred to the initial examples given in 2001 and 2005, et cetera, et cetera. So obviously, that was long, long back. And the intent there is perfectly okay. But the examples given leave a lot to the imagination. I think it can be streamlined very nicely. And if you're saying that, okay, limited risk strategy will only take the risk as the exposure, I think that is fine. But then all types of limited risk strategies should fall under that, not just an option buying kind of approach, which the regulator right now has a very, very standardized approach there. So I think some of those things, even baby steps there, will help a lot to the industry.
Yeah, I think I'll just add something.
Sure.
Right. We have to look at the industry as of now. Is fairly, is not as transparent as the mutual fund industry. There, the regulatory oversight is a lot more. And, Aditya and you guys at Equilify and IBC have been doing a very good job as far as bringing the industry together. But at the same time, what you have to understand is that, look what happened with the debt funds in the AIF category. That's a setback for the industry. So as long as, we need to increase transparency, we need to strengthen the processes as far as the industry is concerned for it to grow. Yeah. Because wherever there is lack of transparency, there are going to be people who will come and try and scheme the things. Today, the mutual fund industry, because of such high regulatory oversight, the chances of inappropriate behavior within that industry is far less. So once that to me is the most important aspect for our industry to grow. And we've been worried as far as whatever happened on the debt front for a very long period of time. And it's only when the regulator came out, it's a setback for the industry. So we need to strengthen our processes, we need to strengthen the transparency. And while you guys have been doing a very, very good job, we need to work a lot more on that. For the industry to grow, investors need to have faith.
Absolutely. No, very valid points. Just the final bit of concluding remarks from from you guys. Vaibhav, to start off with you first. Equity markets are at all-time high. Debt mutual fund tax arbitrage has been taken away, and there's too much money, as we were discussing earlier, flowing in the performing credit AIF category. Do you think this is a perfect time for hedge fund strategies to become more and more prominent in investor portfolios?
Yeah, I think, Alekh, the way I would put it here is basically there is always the best time to be in hedge funds. It's not about when the markets are up or probably people are looking for a hedge. Because that hedge funds have an ability to manufacture strategies, which I earlier said, right from being very conservative to be aggressive as well. I think the ability or the I would say the vehicle freedom in terms of the leverage and a lot of innovation which you can probably do under this umbrella kind of makes a great addition to your overall portfolio, right? It brings uncorrelated return, which gives tremendous amount of balance to your overall portfolio. So it's always a good time, whether it's a conservative strategy or an aggressive strategy, to fit right into the bucket of a portfolio.
Perfect. Rishi, just on that, we have many debt plus kind of strategies out there, but globally there are multiple other strategies. There is even fixed income long short funds out there. Do we see India growing to that level anytime soon?
Yeah, I think it started happening. It's on the fringe and on the cusp now for the future growth. But for example, I have done managed futures kind of strategies for a long time in the past in various structures. A little bit of that has started happening even in the long short funds here. And the attempt that the industry has made has been to deliver some equity plus, equity minus returns with better risk return adjusted profiles, as I was mentioning earlier. So I think with more strategies, more people coming on board there, you'll start seeing much better results on that side. I think right now results so far have been middling on that front, so which is why the interest is not also taken off. So that is a sort of a chicken and egg kind of problem. But yes, in terms of the fact that 5 years back there were not too many such strategies anyway, now there are. So on the managed future side, I clearly see some other people I know doing things. I'm doing some things on that side. And then again, options, of course, the volumes have gone through the roof in the last 5-7 years. So before that, obviously, you could not necessarily have options only focused strategies, but now you potentially can. So those type of strategies are anyway, now I think you're going to see more of those going forward. And as Vaibhav said, the non-correlation and other things, obviously it fits in very well. I mean, simple, on your efficient frontier, you'll be much more efficient. Anything you add which is non-correlated, it doesn't matter whether the volatility is very high. So for example, on the managed future side, typically volatility is very high, right? But because it always makes money when nothing else is making money, you're still much better off combining that with anything you have in your portfolio. So I think those kind of things people will need to look at, and more and more strategies are going to come on board now.
Yeah, perfect. Just the final comment from you, Siddhartha. And Siddhartha, we can't leave you without asking your view on the market. Of course, you've told us your view in the short term for small cap, but generally, how are you feeling about Indian markets over a medium to long term point of view?
I think, look, our share in MSCI has nearly doubled Asia, right, over the last couple of years. It is a really, really hot market. And to a large extent, rightly so, our economy has been doing very, very well, right? We have a great leader. All the economic policies are in favor of businesses. But to me, a lot of future growth is already captured into the stock prices. There's no room for error. There's no room for error as far as, and which you saw with HDFC Bank, right? Or today we saw with L&T Mindtree. The results were good, not that bad. It didn't warrant 11% drop in L&T Mindtree today, or a nearly 9% drop in HDFC Bank yesterday. So stocks are priced to perfection at this point in time. There's too much optimism. There's a lot of money that is coming to stock markets, right? Money has to go to, stock market is one part of your asset allocation. You also have to have money going into the banking system, into deposits, because that will lead to productive, industries need working capital, industries need capex, you need money for infrastructure development, capacity expansions. And unfortunately, we have too much money which is chasing the stock markets right now, which to me is unhealthy. Which to me is unhealthy. So again, not much of a bubble as far as Nifty is concerned maybe, but trust me, there's froth like I've never seen before in the small cap space. So yes, cautious. Cautious is the word.
Cautious is the word. Yeah, yeah. Especially after a.
And I'm long-term bull as far as India is concerned. 20 years I've done small and mid-cap investing, and I'll continue to do that.
Yeah.
And I have a lot of first-time investors who say, okay, if the market corrects 20-25%, it is still going to go higher in the long run. But the point is your portfolios are going to get decimated. They're not going to correct 20-25%. They're going to correct 50, 60, 70%. And it's until unless you've not seen a bear market, you don't know what drawdowns can do to you mentally.
Just on that, Siddharth, since you manage small cap money and you're saying small cap as fourth, do we see something else coming from your desk at all, or you would? What would you do?
No, we have plans. Look, we're looking at the international markets. They look very, very attractive as compared to India right now at this point in time. So that's an area that we are exploring, to be honest with you, because the valuation differentials are insane. For all the growth that you see in India, and growth is about the future. March 2020, nobody was so gung-ho on India. So yeah, we go where there's value, and then we let the growth come in, and that's the time where we exit. So
perfect. Thanks so much, panelists, for the discussion. Just to conclude, as we started, very nascent industry, growing very fast, and as we discussed today, in the next 4-5 years, I'm sure hedge funds as well as other category 3 AIFs will become much bigger, and all of us will be part of that journey. Thank you so much for taking the time out today.
Thanks
so much.
Thanks.
Ladies and gentlemen, let's have a round of applause for this wonderful Panel discussion.